One of the biggest challenges business owners face isn't making money, it's managing the flow of money. Revenue comes in unpredictably, expenses hit at odd times, and personal spending and business decisions start mixing together. And even successful business owners can end up asking a frustrating question: where did all the money go? The problem usually isn't income, the problem is the system that handles it. The goal of cash flow planning for business owners is simple. Every dollar should have a purpose. Revenue shouldn't just come in and bounce around between accounts. It should move through a system that separates things, separates business from personal, accounts for taxation, creates personal income, and helps with long-term savings goals. When those pieces are clearly separated and clearly defined, everything gets easier. A simple framework most business owners can use has 4 stages. Stage 1, business revenue. Everything starts with revenue coming into a central location. It's the top of the funnel. All client payments, sales, or contracts should land in this one account I call a hub account. The goal here is clarity. You want to know exactly what the business is generating before anything else happens. Stage 2 is taxes. The next stop for your revenue is tax reserve. One of the most common mistakes business owners make is treating taxes like a future problem. Instead, a percentage of revenue should automatically move into a separate tax account every month. That money isn't yours. It belongs to the government and you're just temporarily holding it. Stage 3 is payroll and owner compensation. Once taxes are accounted for, the next step is paying yourself appropriately. Many business owners take money out randomly, depending on how the month went. A much cleaner system is to treat yourself like an employee. Set a consistent salary and pay yourself every other week or monthly, and create rules for when a distribution from the business should happen and how frequently. That creates predictability and removes guesswork from personal finances. Stage 4 is personal cash flow. Once money reaches your personal accounts, it should follow a separate set of rules and have its own system. This typically includes creating a primary account, we call a hub account, and accounting for things like debt paydown, insurance premiums, and savings, whether it be long-term or short-term goals. We then kick money over to your personal checking account for lifestyle spending and fun money. The key idea is that personal finances should run independently from business finances once the money has crossed that line. Let's walk through a simple example. Imagine a business owner named Sarah who runs a tech consulting agency earning $900,000 per year in gross revenue. Before implementing a system, her finances look like this. Revenue came into the business. Expenses were paid throughout the month. She even paid expenses through a personal credit card to get the miles. She transferred money to herself whenever the account balance looked high enough. And taxes were paid when they were due, often with stress. Even though the business was successful, the process felt chaotic. After starting to work with us and implementing a structured cash flow system, her cash flow looks like this. $900,000 of annual revenue enters her operating account or business hub account. From there, about 30% moves automatically to a tax reserve account, and approximately 25% is moved to her solo 401k. Business expenses are paid from the operating account and often through a business credit card, and Sarah then pays herself a structured monthly salary. From there, we've set up rules on when distributions should happen and at what rates, and we send those out quarterly. Her monthly salary and quarterly bonuses flow into her personal hub account. From there, we account for things like debt and insurance premiums and investing for both long-term and short-term things like travel and home improvements. We then kick money over to her personal checking account at her local bank for lifestyle spending. All she needs to track there is her fun money and lifestyle. Now, instead of reacting to the business account balance, she knows exactly what the business earns, what taxes will look like, when and how she'll get paid, and what's available for her to personally spend. This structure works because it eliminates ambiguity. Business owners often try to make financial decisions in the middle of chaos. But when the system is clean, decisions become much simpler. You can quickly answer questions like, is my business profitable? Can I hire another employee? Can I increase my salary? Can the business support a down year? That clarity is incredibly valuable. There are a few mistakes we see repeatedly. The first is mixing business and personal finances. This creates confusion about what the business is actually producing and what you can actually spend. The second is ignoring tax reserves. This leads to surprise tax bills and unnecessary stress, and sometimes penalties. The third is random owner withdrawal, using the business as your personal piggy bank. This makes it very hard to both plan on the business side and the personal financial side. When business cash flow is structured well, the business starts working for you instead of the other way around. Revenue flows more predictably, taxes are prepared for, and personal finances become stable instead of reactive. If you're a business owner and your income feels strong, but the flow of money still feels messy, that's usually a sign sign of a system issue, not an income issue. We offer a free initial consultation where we'll walk through how your business revenue, taxes, and personal finances are currently structured. In many cases, a few adjustments can dramatically improve clarity and reduce financial stress. You can schedule that conversation using the link below.